The start of the year has seen a flurry of significant US data and political developments. The 30,000-foot view points to US growth outperformance on an absolute and relative basis near term, though in the detail is burgeoning evidence of fragility and growing risk of a lasting imbalance between US growth and inflation. In the December quarter, US domestic final demand grew 3% annualized, modestly above its long-term average. However, 90% of that growth came from household consumption, a striking contrast to the 2 years to September 2024, when consumption contributed 60% of growth. Behind this shift is a marked acceleration in business investment and public demand. Dwelling investment also remains volatile and weak, having stalled for 2 years and, on average, grown just 2% per year the past 5. Looking ahead, President Trump's inauguration has ushered in a wave of private pledges for AI infrastructure spending. The administration also believes new tariffs will elicit rapid growth in manufacturing, but this comes as Inflation Reduction Act-fueled investment winds down. Interest rates also pose a significant impediment to business and residential investment. US firms continue to benefit from low interest costs locked in during the pandemic, but the duration of this funding is 3 to 5 years, in contrast to the 30-year fixed rate terms households enjoy. A material interest rate reset therefore looms for US firms over the next 12 to 18 months. Term interest rates are also unattractive for new housing purchases. In highlighting the narrowing base of US domestic demand, we are not seeking to make the case for imminent weakness. As long as households continue to experience a strong labour market, the use of savings and wealth is likely to allow US GDP growth to remain above trend. The focus for us in 2025 is instead inflation. With respect to price pressures, notable in the investment detail of the past 5 years is the low level of new spending on residential construction and on energy, communication and health infrastructure. As the population continues to grow and demand for energy rises with the use of AI and other technology, prices will adjust to ration available supply. Persistent above-average inflation in these essential categories is therefore likely, as was the case for shelter costs in recent years. Of course, for inflation, we also need to factor in the just announced tariffs on all goods from Mexico and Canada, and that tariffs now apply to all imports from China regardless of value, at a rate that is now 10 percentage points higher. While a reprieve has been given to Canada and Mexico, we expect it to last but a month or two. Additional measures are also expected as US trade flows are analysed and countries already hit by US tariffs retaliate. Combined, these developments are likely to keep annual US consumer inflation near 3% through 2025 and only see it ease to around 2.5% in 2026. We therefore believe it most likely that the FOMC will remain on hold through 2025 and only cut twice in 2026 to 3.875%. We certainly see this inflation and tight policy coming at a cost to growth in 2026. But with capacity constraints and the lingering effects of tariffs poised to keep inflation away from target indefinitely, the FOMC will have to be very cautious in considering additional support for the economy. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.